Hello, just wanted to take this opportunity to provide a quick update on our perspective on the market here at NavPoint Real Estate Group in the midst of this very interesting economic time that we're all experiencing. Post-pandemic and everything that occurred in the last 3 years has created an interesting commercial real estate landscape and economic marketplace in general. Much of that a function as the distress that we saw and the reaction by the Fed to the COVID pandemic. More specifically, the infusion of cash into the money supply and the ensuing inflation that we're experiencing right now. So what that's done is it's created a scenario in commercial real estate where the cost of capital has increased dramatically in the last 12 to 15 months, and in turn has stymied transaction volume. So what we're seeing is some coming distress in commercial real estate, most specifically in the office sector, but certainly other product types are also going to see some of that distress. We know based on the data that there's about $270 billion in commercial real estate loans that are maturing in 2023. In the next 24 months alone, we know that $70 billion of that debt has debt coverage ratios of 1.25 or less, which is a key metric that lenders used to underwrite and check the health of an existing commercial real estate loan. So in this case, a 1.25 debt coverage ratio means that the net income would cover the debt at 1.25 times, which is a minimum threshold that a lender would even consider, and those underwriting thresholds have increased in the midst of the stress that we've seen in the market and the cost of capital. What that's also done in this marketplace, with interest rates rising almost or more than 500 basis points in some cases over the last 12 plus months, is it's created a huge bid-ask gap that's just stymied transaction volume. So the bid that buyers are providing and the ask that sellers are putting assets on the market for sale is huge right now, the biggest we've seen in over a decade, and it's created a scenario where you just aren't seeing transactions occur. So what has to happen is sellers are going to have to reset their expectations, and they only have a couple of options. Really, they can sell an asset that that is underperforming, that has a coming maturity on their loan. They can sell it probably not at a profit, given that vacancy rates have increased, rental rates generally have been flat, specifically in office again, or they're going to have to be prepared to recapitalize the asset with additional equity to meet those debt coverage ratio requirements that their lender will require at increased interest rates. So sellers are in a bit of a predicament, and until we reset expectations for pricing, we're probably not going to see a lot change in terms of transaction volume. Buyers, on the other hand, the moral of the story is patience. Buyers need to be patient right now. With money market rates in the mid 4% range, it's not a bad time to be sitting on cash. We know there's still a tremendous amount of liquidity in the market waiting for those opportunities, and those opportunities will come, and they're going to come probably later this year. They're going to start to come. So I think the moral of the story for buyers is to wait. We're telling our clients to be patient. Our seller clients, we're telling them to batten down the hatches, renew leases, make sure those debt coverage ratio requirements meet lender expectations, and if they've got debt that's got some term left on it, to continue to push forward and maximize net income. So that's the update for now. Good luck in these crazy times.